So we generally, why we don't speak about debt so much is because we think that investors sometimes don't understand that asset class well, especially debt funds, which are duration funds. People think that they are substitute to fixed deposits, they are not. There is a very big difference between a fixed deposit and a debt fund. You can have a negative return in a debt fund, which people believe that debt funds will never give negative returns. So given that differences in terms of understanding that we see, that's why we don't, because our dynamic bond fund is managed very, very well. If you see the allocation calls that we have taken or the duration calls we have taken have worked really well. So going ahead, we think that we are in for a yields should come down going forward, and there are many supportive factors for that. One is inflation is much under control. We are seeing that regulations in terms of the liquidity provisions, etc., that they are mandating are favorable. Global interest rates will be cut, which will allow some room for RBI to cut rates. At the same time, we are seeing a lot of demand from domestic as well as foreign players in Indian debt, because we have now been included in foreign indexes, which will lead to flows over a period of time to come into Indian markets. Plus, there is a lot of appetite from insurance companies and pensions, etc., into long-term bonds in India. And given the fact that government is very much adamant on maintaining the fiscal deficit and lowering fiscal deficit over a period of time, that's a very supportive factor in terms of the future outlook that we have. So overall, we are very favorable in terms of yields going down. So if you understand that space well, and if you have a 2-3 year time horizon, then probably that's a good place to park some of your allocation.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.